this is something as a business that we're rolling out across our capability more and more, and we felt that from an advice perspective, it might be a good idea to get some insights from other advisors, understand the journey that they've been through in terms of coming up with some thematics and how working with Stropro, advisors now have the ability to pull together a thematic into an actual actionable trade, which is rather important. But before we begin with that, and given this will go out more broadly, I'll introduce David Offer from Horizon Investment Solutions to talk briefly, Dave, for 1 or 2 minutes around your background, mate, and where Horizons come from.
Yeah, sure, Nige. Thanks. So we're a financial advice firm based in Western Australia, and we give both financial planning advice and investment advice. And the investment advice is on around 400 million. And really what we're trying to do as best we can is achieve a reasonable risk-adjusted rate of return for our clients on a long-term basis. So we're not any particular sort of animal. We're not a share market animal or a property animal. We try and have a wide range of asset classes. We're happy to exclude asset classes for that matter as well. If we don't like an area of investment, we're happy to have zero exposure. So we're basically looking for at markets in general, and then forming a sort of top-down view, and then building bottom-up portfolios from there. So a lot of direct investments and a lot of ASX investments, but not wedded to any particular asset class.
Thanks, Dave. And I'll introduce Anto Joseph, sitting to my right, founder and CEO of Stropro. Mate, can you give us another 2-second background on Stropro and yourself, please?
Yeah, absolutely. Gents, lovely to meet you all. My name's Anto. It's been pretty exciting to work actually with the IPS team, and particularly as they launched the private markets business, because it allowed someone like Stropro to really plug in and give product capability into those advisors. So just a little bit of a background. Stropro, we're an alternatives investment platform. Initially, I came out of private bank with Citi for a number of years, and I was heading up their Asia desk for a few years from 2016 to 2019. So worked very closely with clients not only in Australia but globally as well, to build product using the trading teams or institutional capability of a wide panel of different investment banks. But obviously there's challenges with that. You need to be a private bank client to end up getting access to those opportunities. So Stropro was really born out of taking that whole legacy thought of being a private bank customer and disrupting that. So we ended up going and partnering directly with a panel of different investment banks across the world. So that includes the likes of Citi, Credit Suisse, Goldman Sachs, Macquarie Bank, Marex Financial, which is like a European issuer that's just kind of emerged its head. And we've got a panel of different investment banks we work with, and then we design and curate products for our advisors and our end investors directly, without the client needing to be a private bank customer. And I think for a lot of advisors out there over the last few years, getting access to institutional capability like that without necessarily parting with your client, to a private banker has been a positive development, if anything, and that's what Stropro does in a nutshell.
Awesome. I'm going to throw a couple of words that you said there around. So you've got design and curate, and access to opportunity. And I guess that's what this call is about, right? How you as an advisor navigating markets at the moment, which are up and down, as they always are, but there's obviously a lot going on in markets at the moment. How do you find a thematic, and how do you tease that out and then get access to that opportunity, I guess? And so Dave, mate, talk us through the journey you've been on in terms of this trade, and we'll talk about the specifics of the trade in a sec through Anto, but how did you sort of come up with the idea for the trade we're going to look at initially, and then maybe we can hand over to Anto for the specifics?
Yeah, sure. So I mean, we're always looking for bargains, like whether advisors or clients. It's there's always in the back of your mind, look, I'd love to deploy cash if only this share was at XYZ price or more markets fell to a certain level. But the reality is that it can happen. You can have those really sharp sell-offs, but in reality, they're few and far between. So what we were looking to do is have some money. You always have to have money for a rainy day for the extreme periods, because that's when you make the really big returns in portfolios. But equally, there's nothing particularly commendable or clever about sitting on cash for years on end, waiting for an opportunity. And frankly, there's nothing defensive about cash when you hold it on a long-term basis. So within our portfolios, we will always have a growth component. We're never fully out of the market, and we're never, in a sense, really fully in the market. We'll always have a defensive component. So, in a sense, it's not that dissimilar to the 60-40, portfolio that is sort of the long-term guideline. But within that 40%, what we're trying to do, we know within that 40%, we will have money that we're willing to deploy. And on that, we're trying to get a decent rate of return while we're waiting for opportunities. So that's where this trade fits in. It's saying, yes, I have money earmarked that I'm absolutely emphatic I'm going to buy companies if I get the opportunity to do so, if they fall. And so I'm not afraid to be willing to be obligated to buy them or commit to buy them. And in doing so, I want to get a decent rate of return. So that was the challenge we sort of put to Stropro a few months ago. So I don't know, it's better that I answer the question on the journey, Nige, because Anto might be a bit tired of this journey, because it's not like, it wasn't a couple of emails, it's gone for months, and I'm still a pain to him. So it's like a nightmare. So it's been a lot of interaction, a lot of going backwards and forwards. And we've done an issue last month, which was fantastic, and we're rapt about it because we went into that at the end of September, and we've still got demand to go again. So we've got this new issue which will close around the middle of November. And while we were wrapped with the timing of the first issue, we're sort of a little bit envious, because with a bit of refinement and a bit more knowledge, the terms of this issue are even a little bit better. So, and that's the collaboration of both ourselves and Stropro, really sort of refining and improving things further. So maybe, Anto, it's appropriate if you run through this series and how it fits in.
Yeah, absolutely. I can jump in then. Maybe we can just share the slide while it's getting up there. But yeah, just in the meantime, for everyone on the call, I think, Dave, you've actually really summarized the context of the discussion really well. I mean, the challenge at the moment is, participating in the equity market with, obviously uncertainties rife. So volatility is a concern. But then there's also the idea of, entering into the market and missing out on returns as well by participating in the equity market. Now, you potentially are in a sort of a suppressed yield environment, at least, or return environment for the next maybe 12 to 24 months. So there's this gap between, for a lot of investors, what to do now, to take advantage of trying to access equity-like returns, but also manage downside risk. That's really the ultimate, the cake that we wanted to make. So just to give everyone a bit of a background on this, I'll probably go to a few slides in. That one there. Perfect. So again, there's a few key components that I'll share with everyone on the call. It's a portfolio strategy that we'd like to put together. So Dave has worked closely with us to create a basket of sort of ASX 20 companies, and there's 11 equities in there. As an investor, you do have the opportunity to invest in a singular strategy out of the 5, but it actually works really well together as a basket of 5 individual strategies. The term of each investment is up to 3 years. And as I mentioned here, one of the unique parts of it locks in an average yield of 8.22% per annum over the term of the investment, and that's locked in and guaranteed by the issuer of this strategy, which in this case is BNP Paribas, who's built the trade for us. right? So you lock in that average yield across the basket today, which is quite unique. There are two defensibility mechanisms that gents, you should be aware of. And the first one is something that you might be more familiar with is a traditional sort of put option, but it's providing a 30% downside barrier across the whole equity basket. So pretty much up to a 30% fall in any of these equities, you as an investor, your clients are 100% protected against that fall. Obviously, the other risk that you should be aware of is the issuer's risk, which is BNP Paribas, but up to a 30% fall in any of these equities, you are protected against that fall. Now, the second defensibility mechanism, which is why we really love this trade and we think it's worth considering in the portfolio, is if that 30% barrier is breached. That means if we do have a significant market downturn from here of more than 30% in any of these underlying equities, the second mechanism steps in. And what that mechanism is known as is a cushion level. And the cushion level is very simple. What it means is that the client is going to be able to access that equity at a discount, basically entering into that equity position at 70% of its initial value. So what that means is effectively you'll soften your losses in a considerable downward market. And for everyone on the call, the only time we look at whether that 30% barrier has been breached is at maturity. So if you have a situation over the next 12 months, 18 months, up to 3 years, where markets fall 31, 40%, 50%, this does not actually impact your capital position. The only time we look at it is at 3 years on the last day. So whether any of these equities have fallen 30% or more. But that cushion level allows you to enter into any of these stocks at a discount. Now, just to summarize the strategy, effectively, if every stock in these basket of 5 trades falls 40% at maturity, right? And that means that barrier has been breached. If every stock were to fall 40%, the overall total return to the investor would still be a positive 10% return. And that's because of that combination of that yield that you're locking in today, as well as the fact your losses would be cushioned in the case of a significant market downturn. So that's a little bit of high level about the strategy. And for those who are a little bit closer on the derivative side, the cushion level is effectively a put strike. So you're basically writing a contract today to buy the stock at 70% of its value if it was to fall.
Cool. Just as before we go, does anyone got any questions on the line just around what Anto's just talked to there?
This is probably a fairly simple question. How do you decide which counterparty to use?
Great question, Anthony. So we've got about 6 or 7 on the panel now, but we price tender this strategy, and that's what Dave mentioned about the number of emails going back and forth. There was probably about 50 emails, but effectively we go out to the whole panel. Each one comes to us with the best priced opportunity, usually in 24 hours. And then we go, okay, who's best priced here? Who do we think from a counterparty perspective is rated well, for the position? And then it goes to an investment committee within our team where we have to, out of the 3 people on the investment committee, 2 out of 3 have to give it the all okay. But it's usually just who's best priced on the street and the strongest counterparty on the panel. The last issue that Dave was mentioning was actually through Macquarie Bank. But this time we wanted to add Macquarie actually into the underlying asset mix in the trade, and Macquarie can't trade on their own stock in the basket. So we went to BNP, we went to Goldman's, we went to Citi, and we went to Marex Financial, as well as Natixis, French investment bank, and the best priced on the street was BNP Paribas.
And is there a general sort of minimum ticket size needed before the deal can go ahead?
Yeah, so typically across each trade, we need $500,000 for that trade to go live. But because we're obviously working with a handful of advisors and investors, what we've been able to do is reduce the minimum ticket for any individual investor into a strategy down to 10,000. So that means an individual investor, if they want the full 5 trades, they'd have to invest 50 grand, which is 10 grand into each trade.
Okay.
Yeah.
And that's something that we can assist with as well. So, if it's, 500,000 launch and you can only get to 400,000, for example, across your book, we can make that available to everyone else out of your book if they want to tap on, I guess, as well, to get you where you need to. One of the important.
Sorry, I mean, just on that first issue, it was, one of the appeal is that we weren't talking about 500,000. I think it was closer to 15 million. So by Stropro and IPS acting as an aggregator, it's giving us buying power as well. Whereas if you've got a client that's got $500,000, it's not really impressing the counterparty. But when you're starting to talk about decent amounts of money, they start to sharpen their pen as well. So that's why we're sort of getting the terms that we are getting by acting as an aggregator.
Yeah, and one thing to add there, David, is our process through the open week period is we constantly go back and forth with the issuer to see if we can pick up better pricing along the way. And we actually push that back through to the end pricing. So we checked with Macquarie maybe about 4 or 5 times in between whether the pricing had shifted a little bit even more in our favor. So that's something we constantly do in the process. So we're ensuring the street is still the best priced product.
So not before we go into the sort of those nitty-gritty bits and pieces, Anto, do you mind running through just a few examples there, just to
absolutely
at individual stock trade level?
Yeah, absolutely. Let's walk through the next slide here. One more. Keep going through one scenario. Before we go to the early maturity, I might just go to an example of the next one. Yeah, okay. So I'll just take the first example of BHP Rio basket, which is the first out of the 5 trades. Here you're locking in an 8.52% per annum yield. Remember, the yield is paid quarterly to investors. So that is guaranteed by the issuer and paid quarterly into the investor's account. Okay. And let's say hypothetically in this example, 100,000 is invested in this product. If BHP and Rio remain above that minus 30% barrier at maturity in year 3, effectively the client will get back 100% of their initial capital, which is 100 grand, and they would have received $25,560 in interest, which is 8.52% per annum for the 3 years. So you're effectively walking out with a 25% return. And we call this a scenario where the downside barrier has not been breached at maturity. If you go to the next one, there. Yep. Now let's have a look at an example where one of the stocks actually breaches the barrier at maturity. And let's say hypothetically, in this case, Rio at maturity, 3 years from now, has fallen 40%. Now, that means it's effectively breached the barrier of 30. So the investor who's invested 100K, at this point in time, they would have still received, what's really important to know, the $25,560 in coupons, which is the 8.52%. So that's guaranteed throughout the product. But this cushion level, which I mentioned before, comes into play. And at that point, it looks like the investor entered into Rio at 70% of its initial value. So instead of investing into Rio at 100% of its initial value, it looks like the client invested into Rio at 70% of its initial value. So the difference between 70% and a 40% fall is actually muted significantly. And so in this case, you still end up with a positive 11.27% total return over that period, which is roughly about a 3.8% per annum return, in this particular trade strategy. So that's just to give you an example, if one of the underlying assets was to breach the barrier. And if we go right to a couple of slides back, this one. Now, what we've built into the product is what we call an early maturity feature. And the reason why I've come to this last is because this is potentially a likely scenario if the market is sideways over the next 12, 18 months. So here, what you have is a situation where we've built in this early maturity feature from 18 months and onwards. And what that means is from 18 months, every quarter thereafter.
Anto, just on this trade, apologies to interrupt, but it's actually from 2 years.
24 months.
Yep.
Yeah, sorry, I should say 24 months. From this particular trade, from 24 months, so from 2 years, we look at the underlying assets every quarter from 24 months. And if the underlying assets, in this case BHP and Rio, are trading flat to positive from where you started, the trade automatically finishes early. You get your last coupon for the quarter, and you'll get 100% of your capital back to the investor. So the early maturity feature, in some ways, people see it as kind of a liquidity event that you create out of the product, or a profit-taking event, but it's been built into the product from 2 years. So something to consider as well.
So technically, if the market rallies really hard, it's going to knock you out after 2 years.
That's right. That's right.
Just Anton, just quickly, mate, on the strikes that you sell the puts at. So are they based on like roughly around where the stock's trading now when it goes live?
Yeah, it'll be based on the 18th of November.
Okay.
So 18th of November, the closing price of all the stocks on that date will be the date from which it's measured from.
Okay.
Yeah.
Yep.
So effectively, that's the close date of the product as well.
Okay.
Yeah.
So Ray, it's sort of a double-edged sword, because we can actually exit at any time. So let's say the market falls substantially in the next 12 months. We might say we want to deploy this money now, so we can get out of it at a cost of 1%, but we're getting 8% a year. So we've still got, in 12 months' time, we've still got a good rate of return, and the issuer still needs to pay us 2 years worth of coupon, which is a cost to them. So we'll have to see how it plays out, but I suspect the trade will be very strongly, the pricing will be very strong, particularly if the market falls early in the trade. If it falls in year 3, then I think we'll start to see a bit of more volatility in the underlying pricing, but it will be very resilient for the first couple of years. So if the market is too low when we go into it, I would prefer them not to strike us out. I'd like the option to get out, but for them not to get out. So you don't want the market super low. You want it. I think you want it cheap or reasonable. And then when you're going, then if you do have to take these shares in 3 years, on a normalized sort of earnings basis, you're buying these companies extremely cheaply. So really, if Rio was say $92.26 on the 19th of November, we're obligating to buy it in 3 years' time at $64.58. But we can still opt to buy it earlier if we want to, and still have our capital, I think, significantly protected.
Yeah. So just to add to that, David, we've launched about 70 different trades on our platform in the last 18 months. And we've never had a liquidity issue. And what we do is, with any advisor or investor, if they do want to exit the position early, as Dave said, it's a 1% buy-sell spread. We look at the mark-to-market value at that point in time, and a lot of the issuers obviously have to just price in the option in that period. So we provide that visibility if you need it through IPS, if that's a requirement along the way.
Just a segue to something that Dave mentioned around costs. And as these trades are constructed, what are the costs and fees that are embedded into it?
Yeah.
And how are they put together?
Yeah, absolutely. So, Anthony, to your question earlier about pricing on the street, what you end up doing is you actually compress, and you get a real visibility of what the banks are pricing up on these structured products, particularly compared to 10 years ago, right? So that whole price tendering process enables us greater transparency. The cost of this strategy is roughly about 50 basis points a year at the moment. So I think if you do this directly yourself using a series of your own options sort of strategies, it will be far more costly to actually implement. What we're able to do is take the balance sheet of like a BNP, which sits at about a couple of $1 trillion at the moment, and be able to use that balance sheet power to be able to try and price off their book. So it does significantly help the pricing, but I think it's relatively a cheap strategy for the risk return optics.
So that 8.22 is net of the 50 bips.
Yeah.
So, and it also includes the packaging of the strategy to enable it to be made readily available to a wide range of investors. So yeah, I think that's a really good outcome.
Just so broadening the conversation out here, obviously Dave's as he's gone through and constructed this has pegged this to top 20 stocks here in Australia. But what else can an advisor come to you with in terms of the pairs? How else can they broaden this out in terms of we're talking about uncorrelated assets?
Yes.
What else could they potentially do in terms of constructing a trade like this?
Yeah, look, it's, to be honest, in the last 15 years that I've been sort of working in the structuring space, this is probably one of the best trades I've ever seen priced. From a risk to return perspective, to participate in the underlying equity at 70% of its initial value and still have the ability to, walk away with 110% of your capital if the market was to correct 40%. And still participate, it's a phenomenal outcome. So I think from the trade, it's just speaking about the trade, probably one of the best trades I've seen. What do a lot of advisors at the moment are coming to us for is purely 100% capital protected products. And some are asking us for some credit default swaps on a lot of the banks as well. So we have capability across the spectrum of the risk curve to go from 100% issuer protected products with BNP, Natixis, Macquarie even sitting at about close to 4%. Credit default swaps on even some of the big four banks sitting at around 5.5% up to 6%, which is quite phenomenal. Unless you thought one of the big four was going to go into the ground. That's quite interesting to me when I start to see that pricing in the market. And we were even offered something the other day from Credit Suisse, a Credit Suisse default swap at about 7%. And I'm not sure those who've been following the Credit Suisse story, but that for me is also something very interesting. So we get a pretty large variety of requests. Something we've been also seeing is people buying into S&P 500 and also NASDAQ, top 20 NASDAQ. Essentially because they think there's been a huge discount to the market and they want to participate for growth over the next 5 years. So any particular request you have, it's almost like, we're able to price it up. But I must say the Oz pairs trade is probably one of the best risk to return optics that I've seen in a very, very long time. And, the back testing shows that we've even got a calculator for anyone on the call that can actually go in and you can actually put a worst case scenario on any of these baskets and understand what your overall return will be at the end of 3 years. So I encourage everyone to use a calculator as well that will be supplied.
From an advisor point of view, I don't actually see a lot of risk of buying CSL at $190 or Commonwealth Bank at 70, or frankly any of these shares at the prices that they're nominated at. So that to me is the opportunity. I hold these shares across my portfolio now. I think it's dangerous not to have, you know, the growth component in your portfolio. I'm not trying to wait for the GFC style event and miraculously time the bottom of it, but I do want to keep some powder dry. So I see the upside in the downside of this trade. And while I'm waiting, I'm still getting a return.
Yeah, absolutely. I think also one thing to note, there is a question come through, but just before that, we take on that question. When you look at this 8.22% average yield, and I'm sure everyone's quite aware, I think there's just going to be significant compression on yield over the next, 4 or 5 years from the equity market alone. And then on top of that, you've got this period where the equity market might just sort of hover between 4 to 6% per annum. And I'm always keen to talk to the bulls of the equity market because I'm always keen to uncover what that looks like. But, you're seeing sort of earnings constraints at the moment. And that's why I think the 8.22% is a very reasonable and comparable yield to take, given that you've got also a 30% cushion on the market as well, and that ability to participate. So from the risk to return perspective, 8.22%, in my opinion, looks very attractive to lock that in today. Also, there's also talk about the yield curve, flattening out over a 3 or 4 year period. So something else to consider there. I think there was a question that's come through. Where do I see that?
No, they've taken it.
Okay. Yep.
Let's talk about the mechanics here for a sec. Assuming there's something you're interested in, if not this trade, but perhaps this trade. So the first thing, if you're Ray or Anthony and you want to put something together, feel free to come through to us here at IPS and we can put you in contact with Anto, or we can share your details with Anto, and obviously we can work together on constructing a trade. Something like this that's already launched and we're actively working through at the moment. You would reach out to the team here, myself or your RM, let them know that there's interest, and then as per any investment that IPS looks after, we'll collate all the information. We'll work with the Stropro guys to put you into the asset. We would debit the bank accounts under the LPOA, put it into the mechanics into the trade. And then what you'll see in a client portfolio, assuming that they take the basket, they'll see 5 underlying trades. So they'll see each pair as a basket. So say if the client puts in 500,000, they'll see 100,000 in one pair, 100,000 another pair, 100,000 another pair, and you'll see those 5 trades in the portfolio on an ongoing basis.
Absolutely.
But it works like any other investment from an IPS perspective, in the sense that you give us the instruction and we go forth and make it happen.
I think the beauty is that IPS, the platform, is able to record these sorts of investments as business as usual, because it is a unique investment, and we can report that very transparently to clients, and Anto, as you said, down to $10,000 a pair trade. So it opens it up on the basis, as long as you are a sophisticated investor, that's something that has to be ticked to enter into this. So just one other point I thought to share, just from my perspective, and everyone has their own way of doing things, so it's just to share my perspective. I'm, as part of this, forming part of the 40% more defensive component of my portfolios, I'm looking to make it roughly 10% of the portfolio as a whole, or 25% of the defensive component of the portfolio. And the reason for that is that basically my maximum exposure to any one share in those pairs trades across the client portfolios is 2%. So while it's 10% of the whole portfolio, underlying risk to each underlying share is only 2%. So it's not like it's dominating portfolios. It's just a tool within my portfolios to give that diversification and give the stability for yield, and that's resonated very well with clients with respect to the first issue and as we go through this issue.
Yeah, I just want to comment on the defensibility feature, and I was working through the calculator before coming along to this session. But even if out of those 5 trades, and I think that's really important on the defensive side, even if out of the 5 trades, 2 had a significant impairment, we had, maybe it's the mining basket, maybe it's the Goodman basket, but if we had a correction of 50% in either of those, as an example, the portfolio would still perform at roughly about 6.5% per annum through the life cycle of the investment. So, I mean, that's what essentially you're buying exposure to the diversified 5 trades, because you got that defensibility. Even if 1 or 2 of the trades significantly underperform, you end up with a very overall, quite a good outcome overall from the portfolio perspective.
I guess I'll open back up for any questions if anyone's got any.
Yeah, Anto, you mentioned before that you talked about potential for NASDAQ and bits and pieces. What about specific international equities baskets there?
Yeah, so we're actually pricing up a lot of the US tech baskets at the moment, and some of the ETFs like Triple Q, and going long on those with about 80% capital protection and leveraged upside over 5 years. So that's what we're doing at the moment for a few families, few advisory groups, just in terms of pricing. I can tell you there is a very subdued risk appetite to Europe at the moment. So Europe is still very much, if you look at dividend yield is back up in Europe, but unfortunately there's liquidity risks across the whole European banking sector that's quite concerning at the moment. So Europe has been actually pushed off the radar unless you've got very deep protection up to 50% potentially on that market. What's very interesting to note is how 2 things. One is how people are viewing sort of the HSCEI at this stage and the Chinese equity market story. There's this view, at least in the short term, there's going to be some upside potential on those markets. And then we were talking to some analysts from Citi at the moment, but it's just about the whole idea of how, I guess, dual circulation in terms of Chinese policy will impact those particular equity markets over the next 6 to 12 months. But the big one that I'm currently focused on is Aussie US dollar. We're seeing that QT, from our understanding, is that sort of every $95 billion of contraction is the equivalent of about a 2 to 3% appreciation in the US dollar. So month on month. So which is quite interesting. So if there's portfolios that are skewed towards US dollar over the next 6 months, there obviously some upside potential to do that and hedge that risk. But yeah, I think what we're seeing is less exposure to Europe at the moment, Anthony, and in terms of broader Asia is seen as a short-term opportunity. The commodity markets have got interesting plays, particularly in copper, that I think people should look into. But I'm happy to share a bit more detail about each one of those market views. If anyone wants to get in touch, we can share our bite-sized commentary on each one and each market and our views if that's of interest. Yeah. We've designed strategies across all those different markets as well.
What I might do is afterwards, I might connect you guys via an email, and if you could just send through to Anthony an axe of recent deals that you put together.
Yeah, absolutely.
And Anthony can get a sense of what's been done there, and I can send that through to anyone, actually, everyone on the call.
So just quickly, Anto, say I put 20 grand into each pairs. Say both get in 3 years' time, both get exercised. Are they buying 10 grand each worth of those stocks? How's that work?
So at that point in time, we've got at maturity, likely there's going to be the option just to take cash on the investment as delivery of the asset. And at that point, we give the advisor, the client, the opportunity to do what they want to do, which is either purchase the asset at that discount or use it to buy other equities. Because fundamentally, if the market was to fall on any of those stocks 50 or 60%, you might still have to figure out whether it's still a stock worth buying, physically. So we actually just do delivery of cash on maturity. But we are discussing with the issuer whether we got to give the option of delivery of equity as an automated thing, but delivery of cash would be the likely outcome. So at maturity, whatever the residual capital is there after the strike price is calculated will be delivered in cash to the investor.
Okay.
So, Ray, just to also confirm, you're exposed to the share that underperforms the worst. So it's so that's part of how we've got the yield up, is that if BHP goes up and Rio goes down, you're exposed to Rio. It's the performance of Rio that counts. BHP is taken out of the equation.
The pricing of each basket is also a factor of correlation of the basket. So the higher in some case, and obviously the beta, but in cases where we've tried to stick to baskets where there's some level of correlation. So you see a banking basket, a consumer goods basket, a mining basket. So the chance of a significant divergence between the stocks is going to be a little bit less likely unless, you've got an external factor like, whatever, specific to that company. But it does help us bring up the yield, as Dave was saying, which is a good outcome anyway. Yeah, I don't have too many words. I think I've spoken a lot already on the trade and on the strategy. Like I said, we're always open to getting ideas and obviously communicating that through the IPS private markets team. We can take it from there to help you price up a few opportunities. I think between now and the end of the year, what we've seen is the pricing on this strategy is held up slightly better with a new issuer, which is a great outcome. And we'll continually keep seeing whether this is pricing up really well as a sort of a drip feed into the asset allocation mix. So, we've got a 3-week period for investors to participate and advisors. So 18th of November is the hard close. So just keep in mind a couple of days before, we really need to, if you're interested and you've got clients who are interested, working with the IPS team is really finalizing any applications and any sort of transfers by sort of the 16th, 17th of November. So that's just more of an operational question, just to leave that with you. And if you need more time on a strategy, we can reprice something for you with a longer strike date. But that's just to keep that in mind.
Right.
Thank you.
Well, that being said, I think it's a good time for us to close here. There's a few action items from my end, and I'll loop back with everyone just to close those out. I appreciate everyone taking the time on a Friday lunchtime. I know in broking circles, this is key real estate for you guys. So thank you very much, and we'll be in contact soon.
Thanks, everyone.
Thanks, gents.
Thank you. Thanks, guys.